we'll talk about the fundamental analysis. And to start our fundamental analysis, main thing we should understand is market cap. How we know the market cap of a company. So market cap formula for market cap is total number of shares into current market price. So for example, say TCS. TCS have total number of shares this much and current market price is this one. Okay. So coming to our Excel sheet, I have taken number of shares and current market price. So this is the market cap it has come, right? So if you see 1264,970, it should be approx or around that 1264,987 because it would have been calculated on the previous market price or few months back. So as per current market price, this is the market cap. So if you go and see Infosys total number of shares in crore is 415 crore 0.4 and current market price is 1437. Okay, so it should be approx that 41504 and this is the price, market price, and this is the market cap 5965. So if you see market cap of Infosys is 5965. So this is how we calculate the market cap. Market cap formula for market cap is number of shares into market price. Okay, current market price of that share. So now we will be listening a lot about the market cap, then this large cap, mid cap, small cap. What is that, right? What is large cap market? No, company. What is mid cap? What is small cap? So as per SEBI rule, this is the formula it has given. SEBI in 6 October 2017 come up with this concept called large cap, mid cap, and small cap. So first 100 company, based on the market cap, if you shortlist all the company from top to bottom or bigger to smaller, first top 100 companies, 1 to 100 are called large cap companies. Then from 101 to 250, this 150 company is called mid cap companies. Then below 250 in the list are called all small cap. So how will you know which companies are large cap, mid cap, and small cap? If you see the Nifty 50 100 index, that 100 companies are large cap. If you see Nifty 50 mid cap, there will be 150 companies, and these 150 companies are called mid cap. And these 150 companies are not includes this 100 company. These 100 companies, large cap companies are different. These 150 companies are totally different. It's not like one out of 150, 100 are large cap, then 50 are mid cap. This 150 mid cap company are mid cap all. Then anything after that, so 100 plus 150 became 250. After 250, whatever company, that is called small cap, and that list you can see in index 250. So there will be 250 companies in the small cap, and all those will not be there in 100 and 150. So these are totally a small cap company of 250 company list. Then they again come up with the concept of small cap, then micro cap, nano cap, like that. Okay, so basically we understand what is market cap and how we say that which company is large cap, mid cap, or small cap. So there is no amount fixed. Okay, amount, say it's not that 50,000 is the large. Any company above 50,000 crore are small cap. Sorry, large cap. Or say any company with 20,000 crore is not the mid cap. It will be that price or value will be keep on changing based on these top 100 companies. Like top 100 companies, whatever market cap comes, that will be the large cap. Then 101, there will be mid cap. Then after 250 company, whatever the market price is called small cap. So hope you understand the large cap, small cap, and mid cap. And what is the significance of this large cap, small cap, or mid cap? So large cap companies are considered huge in size, like TCS, HUL. These are large cap companies, and this company will not grow as fast as small cap or micro cap or mid cap, right? Because say if I give you 10 rupees and I will say that, okay, double this money. So making 10 rupees, 20 rupees is easier. But if I give you 1 lakh and I will say that, double this money, 2 lakhs. So making 1 lakh to 2 lakh is difficult, right? So same thing, the large cap companies growth will be slower compared to mid cap and small cap. Okay, these companies are called blue chip or blue chip stocks or blue chip companies because their size has big, their growth will be slow, but risk will be at the same time less. Say market Nifty falls 10%, then this company will also fall 10%. But when Nifty will come back to normal price, this company will also, large cap will have potential to come back normal. But there will be a lot of companies like small cap or micro cap company which will, Nifty falls, then this company will fall and they will not be able to come back to their original price. Many company could not even come back to before their corona price. When market fell during corona, a lot of companies fall, all the companies fall, large and mid and small. But large company, most of the large cap company has come to their normal price. But if you see mid cap and small cap, many mid cap and small cap companies has destroyed. They are not even, they are now struggling to operate their business, or they have still not come back to their normal price before Corona price. So that is the difference between large cap and mid cap. So large cap will not give you very high growth. They will not be doubling your money every year or every 6 months, but your money will be safe there comparatively is mid cap and small cap. The same thing, mid cap company will have potential to grow, right? Their business. So their growth will be high. At the same time, risk will be high. If some market situation change or some competitor comes, then they will fall in that level. A small cap, they are very small companies. They have started now, or like they are doing business no now, so they have a lot of potential to double their growth, triple their growth, no 10 times, no 10 times to increase their growth of company size, right? If I have one tea shop, I can open 100 tea shops, but there are already company, 20,000 tea shops are there. They will not be able to make 40,000 tea shops in next 1 year or 2 years, like that. So small companies will have a high growth, profit could increase, but that will be the risk also. Like, no, there will be a risk of that it will go down. So volatility will be high in small cap. So we should consider that. Okay. So hope you understand large cap, mid cap in good no depth. The fundamental analysis. So how we will select the companies? Before selecting the companies, we should understand their fundamentals. So let's come to, before that fundamental analysis, what kind of analysis are there in the market? If you see, there are two kind of investors, or two kind of people. One, traders, another investors. Traders invest for long term or particular goal or a specific reason, and they invest in the business. Okay, they look into the business fundamentals, business ideas, what business is doing, and they bet on company's growth. If company will grow, I will make money. So that is the mindset of investor. But traders bet on the technicals. They doesn't bother whether company is good or bad, what they do, how they will do, those things they will not bother. They will simply look into the chart patterns, technicals, and they will say that from there whether this company have potential, no, price has potential to go up or down. And they will be doing for very short term, maybe same day, 1 day, 2 days, 3 days, like that. So traders mindset is focused on the price, totally price and price pattern, but investor mindset is totally focused on the company's business, company's future growth, company's growth potential, their management. So this traders thing, what they do technical analysis. Investors, what they do more fundamental analysis. Okay, so there are two ways to do fundamental analysis. One is quality based, where we'll check the quality of different companies, and second, quantity based. Okay, that I will talk. So in quality based analysis or qualitative analysis, what we do, we check the different kind of parameters or no company. We analyze the company based on the product quality, their business model, their competitors, their growth, their service, what kind of product. Okay, and this qualitative analysis may differ person to person. Same company, you will say it is good, and I can say bad. Okay, suppose no, there is different companies, say Patanjali and Hindustan Unilever. So Hindustan Unilever produce a product called soap, which is say Liril. Okay. The same time, Patanjali also no brings produce soap. So you may be liking your no Patanjali soap for whatever reason, that I want to go for the no made in India thing, or no Swadeshi company, and I may be liking Liril for whatever reason. I like that lemon flavor or freshness or add. So when we do the quality analysis, our own biased come into the picture. Maybe I will be liking that Priti Zinta, so I will like the Liril soap because he was coming into the Liril ad. And you will be like no liking Baba Ramdev for long their yoga and all. So your biased or decision will be influenced by those kind of things. So in quality analysis, we basically analyze company based on their product, their services, their competitor, their business style, their management. Maybe you will be liking Baba Ramdev, so you will be liking their products, like that. Quality analysis can differ person to person. Then comes quantity analysis. In quantity analysis, we basically check the ratios, numbers, like how much profit they are making, what is the growth of the company every year, and their how much money they have employed. So this different ratio called PD, right? ROC, ROE. So this number will be the same for everyone. You will read their balance sheet or their quarterly or annual report. These numbers will be same for you and for me. So here any bias will not come, and it will be hard code facts. So this we will talk in the next session. But today we'll focus mainly on these properties. Okay, fundamental analysis. So we understand what is fundamental analysis, what are the things we focus on fundamental analysis, and in quality fundamental analysis, okay, and quantitative fundamental analysis, what are the things we consider. So in qualitative fundamental analysis, we consider about the products, business model, their growth potential, and in quantitative fundamental analysis, we check the ratios, different ratios, which we will talk much more detail in our next session. Or before selecting the stocks, what are the things we should consider? First thing, we should check long-term chart pattern that we have seen in our previous session, right? Any company which is growing bottom to top, that we should consider for our long-term investing. Any company which is going from top to down, that kind of company we should not. So first parameter is of 7 criteria. We should consider their long-term chart pattern. How is their long-term chart pattern? Okay. Then promoters holding. So in any website, if you go and see, you can find the promoters holding or shareholdings. So promoters holding is this blue part. Okay. So who are the promoters basically? The people who started the business and still holds the stake in that company. Those people are called promoters. So basically, they are kind of founder who started the business. Say, if you see Infosys founder is no Narayan Murthy, so he's promoter, one of the promoters. There are people who started the Infosys along with Narayan Murthy, and they were stakeholders, and they would have sold their share and come out of that. So they will not be the promoter. Promoters are basically in a no for understanding purpose, we can say that promoters are basically owner of the company. So what we see, how much stakes or shares, percentage shares, these company, promoters are holding, because ultimately it's their company. If promoters doesn't have no have less shares, so if company does good or bad, this owners will impacted more. So they have say 70%. TCS have around 70% of their shares. So if company tomorrow will do bad, then this will be most impacted, right? So obviously they will not want to lose the money. So they will be worried about the company's growth and what's happening in the company. But if you see other company, right, Morpin, there mostly investors are stakeholders are public. So if public have more money, then if company goes wrong or bad, right, something bad happens, then public will lose more money, and promoters will have this, less, so they will be less impacted. So we should go for the companies whose stakeholders, share percentage is more than 50%. That is considered good. But also understand this is not the rule written on the stone kind of thing. We should use other parameters also. And if companies stakeholders are distribution is equally, say shareholder for promoter share no promoters holding is say 30%, but remaining stakes are with DIAs and FYs, then public equally are in proper ratio, then we should consider. It's not that always will be there. Infosys, I think they don't have a promoter share, holding more than 50%, but it is still considered good company because a good amount of investors, foreign investors and Indian investors are invested in that, and that balance is there. So other thing we should check promoters holding, then pledge. So do you want me to go one by one? So I can go say, so chart pattern we have seen in details. So let me go. Okay, no issue. I can go say TCS. So what you need to type, we have seen NSE TCS share price. Go there, check that. No, this is good pattern. Right now it's in consolidation phase, but overall growth is upward. So it is good company. Then if you see this Jet Airways. Jet Airways max chart pattern, if you see, it is going down, down, down. So we should avoid this kind of company. We should see 5 years or no, their max, actually max, you can see. Then that will be our first criteria. Then you can see shareholding patterns, right? So shareholding patterns you can see in the say money control. So if you search any company, say Infi, let's say go with TCS. TCS, then once you will come here, you will click shareholding pattern. So this format you will see. It will break, will close in 10 minutes. Okay. So 72% shares promoters have. Then you can see FYIs. FYIs how much? They have 12%. Then DIIs 10%. Then public have 5%. Mostly, if you see in the good companies, public shareholding will be very less compared to promoters in this foreign FYIs and DIIs. Because good companies share these FYIs and DIIs will pick first. They have more potential to buy, right? So they will be buying. So always see, no, this equal distribution companies have a good promoter holding plus FIIs and DIIs are invested, and then you can go for that company. So promoters holding is another criteria.
Which website is this?
Money Control.
Money Control.
So in fee, if you see, shareholding. So this, right, promoter doesn't have 50% here. If you see, promoter's holding is 15%, but DIIs have good amount, right? 35%. And FIIs also have a good amount. So if you see, FIDIIs are also invested well, and public is also in, I think, equal percent. How much is the public? Around 15%. So its shares are equally distributed among all the stakeholders, right? Promoters, DIIs, FIIs, then public. So this kind of a company also we can consider for that. Not that always it should be 50%, but if promoters are less than 50% and FII, DIIs are not there, all the stocks are with public, then avoid that kind of company. Then comes pledging. So in the same place, you will see the pledge. If promoters holdings are there, and then you can see pledge percentage, right? So this company, it's Infosys that doesn't have pledged any of their shares. So let me see if I get example of any pledged shares, how you can see. SpiceJet, I had example. So SpiceJet, I will go. Shareholding, yes. What, where is shareholding? Yes. So here you see, right, this company. Promoters have around 56, that is more than 50%. So it fits in our criteria. But if you see pledged share, this green one is pledged share, right? So this placed one is green one is placed here, and whatever like 59%, right? Promoters have, but majority of their shares are no pledged. They have loaned it out. They have sold their shares and taken the money from banks or someone. So if some bank wants, they can sell their no shares. And mostly the public. Public have 43% and FIIDIs are zero. Almost they have come out, right? So you should check from place shares, how much place there. Placing normally consider different analysts consider different level, but 15 to 25% placing considered okay. They can manage that placing things and they can get it back. Okay. But if it is more than 25%, avoid that kind of company. So placing we can consider up to 15 to 20, 25%. Consider okay, placing. Then debt free. So other parameter is called debt, how much loan company have. So we should consider the company which have zero debt. Zero debt is best, and if they have debt, that should be minimum or that should be in decreasing order. Okay, so small cap and in mid cap company, if you go, they will have some debt. That is okay, because to grow the business they need a loan, but that should not be keep on increasing. Also, it should be minimum D ratio they call that, we'll see. So that debt should be less. If zero debt, that is best. So here you can see, right, in this infi, debt is zero. In money control also you can see that debt, when you search no their balance sheet, you will see in detail. So long-term borrowing, long-term provision, then so this is what, which company? This is TCS. So TCS, you can say that reserves, this is the amount they have in crores, 74,000 crores, and they don't have any loan, right? So these things, this short-term loan is okay. Long-term loan should be zero or decreasing order. So if you how to see the loan thing, right? So what you can see, balance sheet of any company, you say Reddington stock I have. So I want to see the balance sheet of Reddington. So you can see long-term borrowing, they had a loan of 94 lakhs, I think. It's one less than 1 crore, right? It will be in crores. In 19, now they have come out of it. Zero loan. So we should consider the short-term loan is okay. Short-term loan is something they have to repay within 1 year, and long-term loan is like that is something which they keep on paying interest. So whenever they get the net profit, out of that net profit, the maximum portion they will paying the interest. Okay, if they have a lot of loan. So that's why we should avoid that kind of company. So what other parameter we saw? Debt, then investor holding. Investor holding I already told you, right? that stakeholder, how much FY mutual funds, FYIs, DIIs have shareholdings. Yes. So this is what they should have FYI, DIIs. Then you can see the mutual funds. There should be somewhere details. Yes. So you can see here more details. DIIs. So here you can see all the mutual funds, right, who are invested. So Infosys, I think Reddington, the HDFC Mutual Fund, ICICI Prudential, Tata Mutual Fund, these companies have invested. In FIIs category, you can see all the FIIs details who have invested. So there should be mutual fund schemes. So all these mutual fund scheme will have, they have invested. So any company, if you're going, you should see there, how many foreign investors and fund investor or institutional investors have invested. So there should be. So consider that. Then investors, then website and management we will cover after the break, and then we will go for the exercise of checklist. This checklist, okay?